Something just broke in the precious metals market. And I'm not talking about a minor technical glitch or a temporary blip on the radar. I'm talking about a fundamental shift in the power structure that's controlled gold and silver pricing for decades. The banks, the institutions that have orchestrated every major move in these markets since the 1970s, just lost their grip. And what's happening right now is going to reshape wealth preservation for an entire generation of Americans. Let me show you exactly what I'm seeing, because the evidence is staring us right in the face. For years, the COMEX has been the battleground where paper contracts dictate the price of physical metal. It's a system where a handful of major banks could short massive positions, suppress price rallies, and maintain control through sheer volume of derivative contracts. But something changed. The data coming out of the exchange shows a pattern we haven't seen in modern market history. Non-US banks were holding net short positions representing over 200 million ounces of silver. Think about that number for a second. That's not speculation. That's documented positioning. And when silver started its parabolic move, those positions became a ticking time bomb. Here's where it gets interesting. The traditional playbook for these institutions has always been the same. When precious metals start rallying, increase margin requirements, flood the market with paper contracts, create selling pressure, and regain control. It's worked like clockwork for decades. But this time, the physical demand is so overwhelming that the paper manipulation is breaking down. Industrial users need silver for solar panels, electric vehicles, and electronics. They can't wait for lower prices because their production lines depend on steady supply. Central banks around the world are accumulating gold at rates we haven't seen since the Cold War. They're not buying paper promises, they're demanding physical delivery. And retail investors, burned by inflation and currency devaluation, are pulling metal out of the system faster than it can be replaced. The mechanics of what's happening are actually quite simple once you understand the structure. The COMEX operates on a fractional reserve system for precious metals. For every ounce of physical gold or silver in the vaults, there are multiple paper claims against it. It works fine when most contract holders settle in cash or roll their positions forward. But when delivery demands spike, the whole system gets exposed. And right now, we're seeing delivery demands that are stretching the system to its breaking point. The registered silver available for delivery has been dropping while open interest remains elevated. That's the classic setup for a squeeze. Now, before we go further, I want to mention something quickly. If you're watching this and you've got retirement savings sitting in traditional accounts, I put together a free guide that breaks down the wealth protection strategies thousands of American retirees are using right now. It's in the description below. No cost, just practical information about safeguarding what you've worked your whole life to build. Grab it if that's relevant to your situation. Back to what's unfolding in these markets. The banks losing control isn't just about silver. Gold is experiencing its own structural shift. When you look at the flow of physical metal, it's moving in one direction, east. China and India have been accumulating at unprecedented levels. The Shanghai Gold Exchange is now handling more physical volume than London in many trading sessions. That's a complete reversal from historical norms. And it's not just private buyers. The People's Bank of China has been adding to reserves month after month. Russia, despite sanctions and economic pressure, continues to convert dollar reserves into gold. Turkey, Poland, Singapore, the list goes on. These aren't speculative trades. These are strategic moves by sovereign nations preparing for a monetary system that looks very different from the one we've known. The Western banking system built its precious metals control through the London Bullion Market Association and the COMEX. These institutions created a paper market so large that it dwarfed physical supply. And for decades, that paper market set the price. But when physical demand exceeds available supply, paper promises lose their power. We're watching that transition happen in real time. The premium for physical metal over spot price keeps widening. Delivery delays are becoming common. Refineries are running at capacity and still can't keep up with demand. These are not the characteristics of a market under control. Let me give you a specific example of how this plays out. A major bullion bank holds a short position in silver futures. They're betting the price will go down, or at least stay contained. But industrial demand surges because solar panel production is ramping up globally. At the same time, investment demand increases because inflation is eroding purchasing power, and investors want hard assets. The bank's short position starts losing money. Normally, they'd just add to the position push the price down through coordinated selling, and wait for weaker hands to fold. But this time, the physical buyers aren't folding. They're taking delivery. The bank now faces a choice: cover the short position at a loss, or deliver physical metal they might not have. If they try to source physical metal to deliver, they're buying in a tight market, which pushes prices higher, which makes their remaining short position even worse. It's a feedback loop that can spiral out of control very quickly. This is exactly what happened during the silver squeeze attempts in the past, except those were driven primarily by speculative fervor that eventually faded. What's different now is the structural demand. Solar installations aren't going to suddenly stop because silver prices rise. Electric vehicle production isn't going to halt. 5G infrastructure build-out isn't optional. These industrial applications create a price floor that didn't exist in previous decades. And when you combine that industrial floor with investment demand and central bank accumulation, you get a market dynamic that's fundamentally different from anything we've seen before. The historical parallels are instructive but not perfectly applicable. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions, drove prices to record highs, and then the exchange changed the rules. Margin requirements were increased, position limits were imposed, and the squeeze was broken. The Hunts were forced to liquidate at devastating losses, but they were individual actors who could be isolated and targeted. Today's squeeze isn't coming from a single source. It's coming from industrial necessity, monetary policy divergence, and a global loss of confidence in fiat currency systems. You can't change the rules to stop a solar panel manufacturer from needing silver. You can't impose position limits on central banks accumulating gold. The nature of the demand is different, which means the traditional control mechanisms are less effective. Look at what happened in 2008 during the financial crisis. Gold and silver initially sold off as everything did. Margin calls forced liquidation across all asset classes. But then something interesting occurred. As central banks launched unprecedented monetary stimulus, precious metals began a multi-year bull run. Investors realized that printing trillions of dollars would have consequences. They were right. The difference between then and now is the scale. The monetary expansion since 2020 makes 2008 look modest. The debt levels are higher. The geopolitical tensions are more severe. And the alternatives to the dollar are more developed. Countries can now trade in yuan, settle in gold, or use digital systems that bypass Western banking entirely. That wasn't possible 15 years ago. The BRICS nations are actively working on alternative payment systems. They're not doing this because they hate the dollar. They're doing it because they've watched how financial sanctions can be weaponized. If your country can be cut off from SWIFT, frozen out of dollar clearing, or have your reserves seized, you're going to look for alternatives. Gold becomes attractive because it's no one's liability. It can't be printed, sanctioned, or devalued by decree. Silver benefits from the same monetary concerns while also having industrial applications that create independent demand. This geopolitical restructuring is happening slowly, but it's happening, and it's creating persistent demand for physical precious metals that didn't exist in previous cycles. Now let's talk about what this means for the average person watching this video. You've probably noticed that your grocery bill keeps going up. Your energy costs are higher. Your insurance premiums increased. The official inflation numbers say everything is fine, but your lived experience tells a different story. That gap between official statistics and reality is why people are losing faith in the system. And when faith in the currency erodes, people look for alternatives. Historically, that's always meant gold and silver. Not because these metals have magical properties, but because they're finite, they're tangible, and they've held value across thousands of years of human civilization. The banks losing control of precious metals pricing is actually a return to normal. For most of human history, gold and silver were money. The paper currency system we use today is a relatively recent experiment. And like all experiments, it can fail. We've seen it fail repeatedly throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina, the list goes on. Every fiat currency eventually loses value. The only question is the timeline. When you see major institutions losing their ability to suppress precious metals prices, what you're really seeing is the market reasserting the fundamental value of these assets against the backdrop of currency debasement. Here's something most people don't realize. The silver market is tiny compared to other commodities. The entire above-ground silver supply that's available for investment is worth less than the market cap of many individual tech stocks. When serious money starts flowing into silver, there's not enough supply to absorb it without significant price appreciation. Gold is larger, but still small relative to global financial markets. If even a small percentage of the money sitting in bonds, stocks, or cash decided to move into physical precious metals, the price impact would be enormous. And that's exactly what the banks have been trying to prevent. Because once that rotation starts, it becomes self-reinforcing. Higher prices attract more attention, which brings more buyers, which pushes prices higher, which attracts even more attention. The squeeze we're seeing isn't just about short positions getting caught. It's about a fundamental mismatch between paper claims and physical availability. Think of it like a bank run, but for precious metals. As long as everyone is content holding paper certificates or digital entries, the system works. But when people start demanding physical delivery, the fractional reserve nature of the market gets exposed. And unlike a traditional bank run where the central bank can print money to restore confidence, you can't print gold or silver. The physical supply is what it is. When delivery demands exceed available inventory, prices have to rise to ration the scarce supply. That's not manipulation, that's basic economics. Let me paint you a picture of what happens next if this trend continues. Industrial users who need silver for production start securing long-term supply contracts at higher prices because they can't risk production shutdowns. That locks up available supply. Investment demand continues as inflation persists and currency concerns grow. That pulls more metal out of the market. Central banks keep accumulating gold as part of reserve diversification. That removes supply from the market. Meanwhile, mining production is relatively inelastic. You can't just flip a switch and double silver output. New mines take years to develop. Existing mines are producing at capacity. Recycling can increase, but it's not enough to offset the demand surge. In this scenario, prices have to rise significantly to balance supply and demand. And the banks that are short can't stop it because they don't control the physical supply. Now, if you're sitting on retirement savings and this is making you think about how to protect what you've built, let me mention something. For Americans with significant retirement accounts, there are ways to hold physical precious metals inside tax-advantaged structures. I'm talking about gold IRAs and similar vehicles. I put together information on how this works, the rules you need to know, and the potential benefits and drawbacks. It's not right for everyone, but if you've got substantial retirement savings and you're concerned about currency devaluation, market instability, or geopolitical risks, it's worth understanding your options. The guide is in the description. It covers the mechanics, the regulations, and what to watch out for. No obligation, just information. Because in times like these, knowledge is the best protection you can have. Getting back to the market dynamics, there's another layer to this that's crucial to understand. The derivatives market for precious metals is massive. Banks use these derivatives for hedging, speculation, and market making. But derivatives are only as good as the counterparties backing them. When physical supply gets tight and prices start moving violently, counterparty risk becomes a real concern. What happens if a major bullion bank can't meet its delivery obligations? What happens if a clearinghouse faces a default? These aren't theoretical questions. We've seen derivatives markets blow up before. Long-term capital management in 1998, the mortgage derivatives in 2008. When leverage meets volatility in a market with limited physical supply, the potential for systemic stress is very real. The regulatory response to a precious metal squeeze would be fascinating to watch. Historically, exchanges have changed rules mid-game to prevent disorderly markets. They've increased margins, imposed position limits, or even halted trading. But those measures work when you're dealing with speculative excess. They're less effective when you're dealing with structural supply deficits and fundamental demand. You can't regulate away the fact that solar panels need silver. You can't impose position limits on industrial users who need metal for production. And you certainly can't tell central banks they're not allowed to buy gold. So the traditional circuit breakers might not work this time, which means the price discovery process could be much more volatile than previous cycles. There's also a psychological component to all of this that's worth considering. For decades, investors have been conditioned to believe that precious metals are relics, that they don't generate cash flow, that they're not productive assets. And there's some truth to those criticisms in normal times. But we're not in normal times. when the currency is being debased, when geopolitical tensions are rising, when trust in institutions is eroding, the characteristics that make gold and silver seem outdated in good times become valuable in bad times. They're no one's liability. They can't be hacked. They can't be printed. They exist outside the financial system. Those properties have value when the financial system is under stress. And right now, the financial system is showing signs of significant stress. Consider the debt situation. Government debt levels across developed nations are at peacetime records. The interest payments on that debt are consuming larger portions of budgets. The only way to service these debts without default is to keep interest rates low and inflate the currency. But keeping rates low while inflation is running hot creates negative real yields. And negative real yields make hard assets more attractive. It's a trap that policymakers have created for themselves. If they raise rates to fight inflation, they risk triggering a debt crisis. If they keep rates low, they risk runaway inflation. Either scenario is bullish for precious metals. The banks know this. That's why they've been trying to keep a lid on prices. But the fundamental forces are becoming too strong to contain. The supply side of the equation is equally important. Silver mining is often a byproduct of other metal mining. Most silver comes from lead, zinc, and copper mines, where silver is a secondary product. That means silver supply doesn't respond quickly to price signals the way a primary metal would. If silver prices double, you can't just double silver production because it's tied to the economics of the primary metal being mined. This supply inelasticity creates the potential for explosive price moves when demand surges, and demand is surging. The solar industry alone is projected to consume massive amounts of silver over the next decade. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. These aren't temporary trends. These are structural shifts in how the global economy functions. Gold supply has its own constraints. The easy gold has been mined. New discoveries are rare. The ore grades at existing mines are declining, which means more rock has to be processed to get the same amount of gold. Energy costs for mining are rising. Environmental regulations are getting stricter. All of these factors put upward pressure on the cost of production. And when the cost of production rises, it puts a floor under prices. Miners aren't going to sell gold at a loss for extended periods. They'll cut production first, which reduces supply, which supports prices. It's a cycle that reinforces itself. The central bank accumulation trend is particularly significant because it represents a vote of no confidence in the current monetary system. When the institutions that manage currencies are buying gold, they're essentially admitting that they don't fully trust the system they're part of. They're hedging. And if central banks are hedging, shouldn't individuals be doing the same? The difference is that central banks have resources and information that regular people don't have. They can see the debt levels, the monetary expansion, the geopolitical risks, and they're acting on that information by accumulating gold. That should tell you something about where we are in the cycle. The technical picture in these markets is also worth examining. Gold has broken through resistance levels that held for years. Silver is showing the kind of volatility that typically precedes major moves. The ratio between gold and silver prices has been compressing, which historically happens when silver is about to outperform. The commitment of traders reports show commercial shorts at levels that have marked bottoms in the past. All of these technical indicators are pointing in the same direction. And when technical analysis aligns with fundamental analysis, that's when the biggest moves happen. But here's what really matters. This isn't about trying to time the perfect entry or exit. This is about understanding that the monetary system is changing. The dollar's role as the global reserve currency is being challenged, not because of any single event, but because of a gradual erosion of trust and the development of alternatives. When that process reaches a tipping point, the repricing of hard assets relative to paper assets could be swift and dramatic. The banks losing control of precious metals pricing is a symptom of this larger shift. They're losing control because the fundamental forces are overwhelming their ability to manipulate through paper markets. Think about what happened when the Swiss National Bank removed the franc's peg to the euro. Years of intervention, billions spent maintaining the peg, and then one day they just gave up. The franc soared. The market repriced instantly. Fortunes were made and lost in minutes. That's what happens when artificial price controls break down. The precious metals market has been under various forms of price control for decades, through the London gold pool in the 1960s, through the COMEX margin manipulation, through central bank leasing programs, through coordinated intervention. But all price controls eventually fail because they fight against economic reality. And when they fail, the snapback can be violent. The implications for wealth preservation are profound. If you're holding cash, you're holding a depreciating asset. If you're in bonds, you're locked into negative real yields. If you're in stocks, you're exposed to valuation risk in a market that's priced for perfection. Precious metals offer a different risk profile. They're not correlated to traditional financial assets. They perform well in inflationary environments. They hold value during currency crises. They're liquid and globally recognized. These characteristics make them valuable as part of a diversified wealth preservation strategy. Now, I want to be clear about something. I'm not saying to put everything into gold and silver. I'm not saying prices only go up from here. Markets are volatile, and precious metals can be especially volatile. What I am saying is that the structural changes happening in these markets deserve your attention. The banks losing control isn't a temporary glitch. It's a sign that the old system is breaking down and a new equilibrium is being established. And in that transition, those who understand what's happening and position accordingly will be better off than those who don't. For those of you who've made it this far, I want to offer something additional. If you're an American retiree with at least $100,000 in any retirement account, and you're serious about understanding how to protect your wealth from what's coming, I've arranged for exclusive one-on-one educational web conferences. These are no-obligation sessions where you can get personalized guidance on your specific situation. It's only available to people who mention they watched this video all the way through. The details are in the description. This isn't for everyone, but if you're in that category and you want expert guidance, it's there for you. The bottom line is this: we're witnessing a historic shift in the precious metals markets. The institutions that have controlled pricing for decades are losing their grip. The physical demand is overwhelming the paper manipulation. The geopolitical restructuring is creating persistent buying pressure. The monetary debasement is driving investors toward hard assets. And the supply constraints are preventing the market from absorbing this demand without significant price appreciation. This combination of factors doesn't come along often. When it does, it creates opportunities for those who recognize what's happening. The banks just lost control of the price. The question is, what are you going to do about it?